So the latest CPI inflation report just came out this morning, and it's actually had quite a large impact on the expectations for the Federal Reserve's rate cuts in their next September meeting. Before the report, markets were actually pricing in about an 84.5% chance of a rate cut. All this data is based off the CME Fed Watch tool. I'm going to put it up on screen so you can follow along for yourself. But that 84.5% chance was lined up for September 17th. So after we received those inflation numbers, those odds jumped from like 84.5% to 94.2%. That's not a guarantee. It's not 100%, but it is getting extremely close to 100%. And in terms of market betting odds, that is pretty damn close. So the reason for this jump is a little bit more nuanced than some of the headlines might make it seem. You might see one outlet saying something like core inflation rises by the most in 6 months, and oh my gosh, this sounds so bad, but another saying that consumer prices rise less than expected. So which one is it exactly? Now, really quickly, headline inflation is the overall CPI number, and that came in at 2.7%. That's unchanged from the prior month. So that's really good news. We would like to see it in line with the expectations. Unchanged is fine. Now, core inflation, which strips out food and energy, rose from 2.9% to about 3.1%, so about a 0.2% increase. And that's the bad news. It's the largest monthly jump in core inflation in half a year. So why is the market reacting positively if we have some neutral news, it was in line with expectations, and then some actually kind of bad news? Well, it's because the investors were worried that tariffs would push core inflation even higher than 3.1%. Now that didn't happen, okay? That just didn't happen. The numbers didn't come in, didn't fall that way. So in the eyes of the market, this was a cooler than feared report. They call it cooling. And that's why the odds of the September rate cut increased so sharply. Now, shortly after the report, President Trump called on Fed Chair Powell, too late Powell, to lower interest rates immediately, arguing that high rates are hurting the economy, though he also claimed that the economy remains strong, which is kind of a confusing dichotomy. Because from the Fed's perspective, there are two main goals: maximum employment and price stability, aka low inflation. Powell has been hesitant to cut rates because the labor market was solid and inflation was expected to heat up due to the tariffs. But since the latest jobs report was so weak and inflation didn't overshoot expectations, that combination makes it harder for the Fed to justify holding rates steady. So whether it happens in September or later, rate cuts are coming. They're definitely coming this year based off of that jobs report. And even after that meeting in September, there are still two more Fed meetings that are on the table for 2025, and both remain in play for rate cuts. So once the Fed starts cutting rates, that typically follows with quantitative easing, aka QE, which injects more liquidity into the system, aka stock prices go up. Historically, easier monetary policy fuels asset inflation, so dips in the market could become pretty attractive buying opportunities within the next couple of weeks to the next month or two. And if we look all the way ahead to the October Fed meeting, current market odds for a cut there is a 62% chance of 2 rate cuts by then, a 35.6% chance of just 1 rate cut, and 1.9% chance of none. So if we're going to play our cards, it's going to fall in the direction of at least 1 rate cut. Now, that's where things stand today after today's CPI release. I will keep you guys updated as we get closer to the September decision. We don't need to make this more complicated than it seems. We have the market betting odds and what professional investors and institutional grade companies are betting is going to happen. And 9 times out of 10, more than 9 times out of 10, they're right. So we're going to follow the money. I'll see you guys in the next video. Peace.